What's up, everybody? Just last week, Fed Reserve Chairman Jerome Powell continued to battle inflation by raising its key interest rate by a quarter point to the highest level in 16 years. But the Fed also hinted at a possible pause to its streak of 10 rate hikes, leading many experts to believe the rate hikes may be over. It's not surprising that Powell may want to step back and reassess after all the turbulence in the banking sector, because he probably wants to see which other banks will be affected and how they will respond. If the end game is to slow the economy and curb inflation, the banks themselves may be the ones to do this if they tighten their lending to avoid a similar outcome as the failed banks. James Knightley, the chief international economist at ING, suggested that with lending conditions rapidly tightening in the wake of recent bank stresses, we think this will mark the peak for interest rates. So what does this mean for the housing markets? We're already starting to see a lot of markets across the country rebound and recover. Some markets are even hotter than ever. CoreLogic and Zillow both have recently revised their housing market forecasts, and Black Knight's research shows that 93 of the nation's 100 largest housing markets show a month-over-month home price increase. Is the housing correction over? Money is still expensive, and the affordability crisis is at an all-time high. So what does this mean for our country? Today we'll take a look at Zillow and CoreLogic's latest forecast, as well as the latest data published by Black Knight Home Price Index and Lance Lambert's article in Fortune titled 93 Major Housing Markets Saw Home Price Gains in March while 7 Declined, says Black Knight, to see where our housing market and, quite frankly, where our country is heading. So let's dive right in. While a pause in Fed rate hikes doesn't mean a significant drop in mortgage rates is coming, it does at least alleviate one layer of uncertainty in the housing market, said Redfin economics research lead Chen Zhao. Unexpectedly bad inflation data, more banking turmoil, or failure to raise the U.S. debt ceiling could throw a wrench in the Fed's plans. But home buyers and sellers can feel a little more confidence that mortgage rates won't skyrocket again. According to Redfin's latest housing market update, the average 30-year fixed rate was 6.39% for the week ending May 4th. This is still double what it was last March, but it doesn't seem to stop buyers from getting in the market. With more buyers bidding and still very little inventory, good houses, and by good houses I mean those houses that are priced right and show well, are still getting multiple offers and getting bid way over asking with very little contingencies. This is right now in May of 2023. As such, prices are going up again even with these high interest rates. And if rates do go down, you can only imagine what will happen. A modest bump in homebuyer demand this spring ran headlong into falling for sale supply, leading to the third consecutive monthly increase in home prices after they'd been pulling back from recent peaks through the tail end of 2022, essentially nationwide, wrote Andy Walden, VP of Enterprise Strategy at Black Knight. Black Knight reported that only 7 of the 100 largest housing markets saw a month-over-month home price decrease. According to Lambert, just 5 months ago, prices were declining on a month-over-month basis in 92 of the nation's 100 largest housing markets. The biggest one-month gains were found in Midwestern and East Coast markets, such as Columbus, Ohio, up 1.08%, Hartford, Connecticut, up 1.04%, and Worcester, Massachusetts, up 1.04%, while the sharpest one-month declines would be found in Western and Southwestern markets, such as Austin, Texas, down 0.72%, and Provo, Utah, down 0.24%. And like I said at the beginning, both CoreLogic and Zillow have revised their housing market forecast. The CoreLogic HPI forecast indicates that home prices will increase on a year-over-year basis by 4.6% from March of 2023 to March of 2024. While housing markets across the country continue to give mixed signals, prices in many large metros appear to have turned the corner. The monthly rebound in home prices underscores the lack of inventory in this housing cycle. In addition, while the lack of affordability generally weighs on home price growth, mobility resulting from remote working conditions appears to be a current driver of home prices in some areas of the country, said Selma Hepp, the chief economist for CoreLogic. They do cite several markets with a very high risk of a home price decline over the next 12 months, which include Provo-Orem, Utah, Boise City, Idaho, Lakeland, Winter Haven, Florida, Salt Lake City, Utah, and Ogden-Clearfield, Utah. Zillow revised their home value forecast to reflect a home price increase of 0.6% over the next 12 months. Mind you, Zillow's been having some issues lately, so we may not want to double down on their forecast. Just last week, they reported a loss of $22 million between January and March. But I digress. Remember, these housing price forecasts are national, and like I always say, real estate is very localized. Among the 100 largest markets tracked by Black Knight, 53 housing markets ended March below their 2022 peak price. Meanwhile, 47 markets are back or above their 2022 peak. However, even that metric marks an improvement from February, when 75 major housing markets were below their 2022 peak price, and only 25 markets were back or above their 2022 peak. The markets where home prices are down the most since the peak are places like Austin, down 13.3%, San Jose, down 11.4%, San Francisco, 11.2%, Seattle, down 10.9%, Phoenix, down 10%, Las Vegas, down 9.4%, Boise, down 9.4%, Stockton, California, down 9.4%, Sacramento, down 8.7%, and Salt Lake City, down 8%. Nationally, home prices are still down 1.7% from the 2022 peak, according to the Black Knight Home Price Index. But what about affordability? Black Knight's Walden pointed out that despite shifting market trends, we're not necessarily out of the woods yet when it comes to falling home prices. Affordability, despite modest improvement, remains roughly where it was at the peak of the market in 2006 nationally, requiring approximately 1/3 of the median household income to afford the mortgage payments on the median-priced home purchase at today's income and interest rate levels. And Ryan Sweet, the chief economist at Oxford Economics, commented that if inflation were to accelerate, then the Fed won't hesitate to resume hiking interest rates because they're determined to break inflation's back. As such, there is a risk that this pause is temporary. So it seems like we're in a no-win situation when it comes to affordability. Money is still expensive and may go up if inflation gets worse, and home prices are on the way back up and may go up even more if rates go down. But what do you guys think? Do you think the housing markets are going to continue to escalate? Are you seeing multiple offers like I am here in the DC area, or are you seeing a lot more inventory and price reductions? Definitely comment below, because that's the best way we all can really understand what's happening across our country. Let's take a quick look at Redfin's latest housing market update to see the current market conditions and the trends moving forward. New listings of homes for sale fell 22.9% year over year, the second biggest decline since May of 2020. The biggest was the 4 weeks ending April 9th, which included the Easter holiday. They rose 9.2% on a month-over-month basis, which is pretty typical for this time of year. Active listings, the number of homes for sale at any point during this period, was up 5.9% year over year, the smallest increase since the summer. Active listings fell 2% from a month earlier. Typically, they post month-over-month increases this time of year. This means that homes are getting snatched up faster, which says to me that either sellers are pricing their homes better or they're just showing better than they were before. Pending home sales were down 16.8% year over year. They rose 3% on a month-over-month basis, which is pretty typical for this time of year. Pending home sales fell in all of the metros that Redfin analyzed. They declined the most in Seattle, down 35.5% year over year, San Francisco down 33.2%, Oakland 32.9%, Portland, Oregon down 32.6%, and New York down 31%. Homes that sold were on the market for a median of 33 days, the shortest span since October. That's up from 19 days from a year earlier, which was close to the record low. On average, 4.8% of the homes for sale each week had a price drop, up from 2.8% a year earlier. And the months of supply, which is a measure of the balance between supply and demand, is 2.7 months, which is up from 1.9 months a year earlier. And to give you guys some context, 4 to 5 months of inventory is considered a balanced market. So 2.7 months is still a seller's market. This week, Inman came out with with an article on Open Door CEO Caryn Wheeler and how optimistic she is for the future of Open Door. I'm not sure I believe her. Did you guys see the video I did on Open Door last week? If not, definitely check it out. I think she may be protesting too much. Thanks for watching. I do appreciate it. Bye!